And good morning once again, options traders. Welcome back, everyone. I had a trader recently ask about combining long and short straddles. And this is an important topic, not just for straddles, but really for all strategies. And what he was talking about is that if we combine a long and short straddle, we can get different outcomes. We can get different risk graphs. And it's an important topic because once you understand how to do that, and the different looks that we can get, if you understand how to put them together, you can understand better how to take them apart. And that's going to give you better insights into hedges, rolls, morphs, and even potential risks. So let's go take a closer look at combining long and short straddles and the different ways that we can view them. As always, before we do, please be sure to click like and subscribe. Always greatly appreciated and helps so much to promote the channel. So, strategies. Remember, to make the most of trades, you must understand different ways of viewing strategies. And this allows you to see different hedges, rolls, and morphs. So, for starters, what's the equivalent of a long and short straddle at different strikes? Now, to answer that, we have to do a quick review of a straddle. Remember, it's a strategy that involves a long call and a long put. If you are long the straddle, meaning that you've paid for it, that you own it, you will be a long call and a long put at the same strikes and the same expiration. If you're a short straddle, you're just on the opposite side. It's a short call and a short put, same strikes and same expiration. So the question we want to start off with, what happens if you buy a straddle at one strike and sell a straddle at another strike? So we're going to be long a straddle and short a straddle, but at different strikes. So for example, let's say that you buy the May $100 call and buy the May $100 put. That would be a long $100 straddle. But then you sell the May 105 call and sell the May 105 put. That would be short the May 105 straddle. So here we go. Here is our long straddle. This is our all too familiar V-shaped risk graph. We get a single bend even though we have two different options, a call and a put. But remember, the bend always occurs at a strike price. And because we have only one strike on our long straddle, we just get one bend. But we are profitable if the stock makes a big enough move out here to the right, to the bullish side, or a big enough move down here to the bearish side. But we need movement. It's got to make a fast, aggressive move. If the stock stays somewhat neutral, or at least between these break-even points, you will incur some kind of a loss. So that's our long straddle. Now the short straddle, of course, is going to be just this flipped over. And it will, of course, have the opposite characteristics, meaning that if the stock now makes a big move up or down, now you're going to be in losses. But if the stock stays reasonably close to that strike, then you will have some kind of a profit at expiration. Okay, so that's our long and short straddles at the same strike. Of course, you wouldn't want to do that. That would just flatten the position. I'm just showing what a long and a short straddle look like. But what if we want to change the strikes? What if we want to be long the 100 straddle and maybe short the 105? Well, here's one way to figure it out. All right, we've seen this type of a diagram before. We have our long and short calls over on the left, long and short puts over on the right. So if you buy the 100 straddle, you're going to buy one call, put a 1 under the plus column, you're going to buy one put. So that's our long 100 straddle. If you sell the 105 straddle, you're now going to put on some short positions. You're going to have a short call at the 105 strike and a short put. So if we look at them left to right, we can see that's a long straddle. Again, left to right, that is a short straddle. But we could also look at them just in a column, just over here under the calls. So if we look at that, that's a debit spread, and over here on the right is a credit spread. But they're both bullish positions. So we should come up with a bull spread of sorts. So let's do that. Let's buy the 100 straddle. There's our bend at 100. And if we put on a short straddle at 105, now we see that we've got different strikes. We have a bend at 100 and a bend at 105. So there's our 100 strike, there's our 105. But notice that we have two parallel lines in here. We've got 200 deltas between these dotted lines. So you're actually going to have a vertical spread with 200 deltas in the middle. And so if we combine these, if we put the long 100 straddle and the short 105 straddle, combined, you're going to get this. And again, it's going to look deceptively similar to a vertical spread, except that you have 200 deltas in the center. So it's just really two vertical spreads. So again, that's one way to view this strategy, because we could, let's say if you're long a straddle, you could leg into this by selling a straddle. Or if you have the straddles, you can see them as vertical spreads. It just starts to open up the doors to a lot of different ways to make trades to where you can get some money off the table but still stay in the position. All right, so that's one look. Let's try a different question. What if you used the same strikes but with different expirations? Still going to use two straddles, but they're going to have the same strikes. Well, let's go back to this diagram like we saw before. Let's say that we have March options and we have January. So if we buy the March 100 straddle, we're going to be long a call at the 100 strike, and we're going to be long the 100 put. So that is a long March straddle at 100. What would happen if we shorted the same strike at 100 but for less time, let's say for January? Now we're going to be short a $100 call and short a $100 put. So again, just looking left to right, or let's say just within January, that is a short straddle. If we look down in March, we are long a straddle. But we can also look this way. If I'm long the March 100 call and short the January 100 call, that is a calendar spread. Same thing over here. I'm long a March 100 put and short a January 100 put. That is also a calendar spread. So this is really a double calendar of sorts. Now, normally you would do different strikes for a double calendar, but this is still two different calendar spreads nonetheless. And so this is what your risk diagram would look like at expiration, or at least expiration of the shorter term contract. And right now, the current curve would be right here in red. And as time passes, that red curve is going to start moving towards the black. So now we have a completely different picture. We've got two straddles, long and short like we did before, but because we're using different expirations, but the same strikes, now we get a completely different picture. Now we get one that is positive theta, but is also a double calendar spread now. So even though it sounds like it's the same idea, we get radically different pictures. All right, let's try another one. What if you used different strikes with different expirations? All right, we just saw the same strike but different expirations. What if we keep the strikes the same? Let's go back to our diagram. Let's use the March 100 call and the March 100 put. But now let's sell the January 105 call and the January 105 put. So once again, if we look left to right, or just within January, we have a short straddle. If we look left to right here or down in March, we have a long straddle. One is at the 100 strike, our long straddle down here. One is at the short strike right here at 105. What's this going to do for us? Well, now we have a diagonal spread. If we look just vertically, I'm long the March 100 call and short the January 105. We've got different strikes and different expirations. That's a diagonal spread. Same thing over here on the puts. I'm long the March 100 put and short the January 105 put. That is a diagonal spread. And so we should just double up on a diagonal spread, and this will be our resulting risk graph. At expiration of the shorter term contract, we're on the black line. Today we're on the red line. And as time passes, this red line moves towards the black. So the main thing to take from this video is that really for any strategy, you have multiple ways of viewing it. And if you don't see different ways of looking at a strategy, you're going to be very limited in your hedges, rolls, and morphs. So it was a good question from one of our traders, and I hope that gives you some insights into the various ways of seeing long and short straddles. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.